Hello and welcome to the latest Insider interview. I am here with Jon Forster, manager of the Impax Environmental Markets Investment Trust. Jon, thank you for coming into the studio.
Thanks for having me.
So, sustainable investing has really taken off in the past few years, but you've been doing this for 20 years already. So what makes Impax Environmental Markets investment approach different to other people today?
Well, I think the first thing is it's highly authentic. We spent 20 years carefully analysing what's in and what's not in environmental markets. We've done it ourselves in partnership with people like FTSE. So there's really careful assessment of the sectors we're investing in. So if you think the amount of concerns of greenwashing, there's none of that in Impax Environmental Markets. The second thing would be purity. We're only investing in pure play companies with more than 50% of revenues in environmental markets, and the average across the portfolio is 85. So it's very pure exposure to this growth story. Next, really kind of team and people. Bruce and I have been managing the strategy for best part of 20 years. So that kind of stability of team, recently joined by Fotis, but supported by a team of 40 analysts and PMs. So we've got a huge resource that's pointed at understanding these sectors. Outside of that, having a 20-year track record is also pretty unique. So the length and strength of the performance track record, together with the measurement of impact. So I think IM was one of the first funds to calculate the net environmental benefit, which is not a specific objective of the fund, but it's an outcome of investing in Impax Environmental Markets.
And environmental markets, what do you really mean by that? So what types of companies or sectors are you actually investing in?
Well, we're investing in a very broad range of sectors. So it would include new energy, clean and efficient transport and water, circular economy, sustainable food, and what we call a smart environment. So it's a diverse range of sectors. When it comes to companies, we've got a global universe of 1,400 companies, so it's a huge pool to pick stocks from. We cover the names locally with boots on the ground in the US, London, Dublin, and Hong Kong. I think another key feature of the companies that we're attracted to is they're all proven profitable businesses. We learnt the hard way that investing in blue sky, early stage, unprofitable companies is not the way to make money in environmental markets. So that's another key focus. The last thing is for investors to understand the fund's a bit different to global equities. So you do get a lot of industrials, utilities, and material exposures. We don't have a lot of healthcare, and we have no energy and financials. So the result of that is it behaves differently with a kind of relatively high tracking error to global equities.
And these big environmental themes, have they remained the same over the 20 years you've been managing the trust? And in, say, 5 or 10 years' time, do you still expect these areas to be incredibly important?
Well, having done this for 22 years, I think the joy of it is that environmental markets has only become a more diverse, more global, more compelling investment opportunity over the years. We've successively found new sectors, emerging themes to invest in that bring growth, diversification, and a really kind of vibrant portfolio. So there's quite a lot of different themes, but maybe just to pick a few of them. The first would be energy efficiency, and that would include things like heat pumps, high efficiency lighting, smart meters, energy storage, all of these kinds of opportunities. So you've got tightening efficiency standards that drive growth. You've got companies that are effectively selling cost savings. And if you think in a rising energy price environment, that's only getting stronger as an opportunity. So that would be the first one. The second one we call the circular economy. It's a range of opportunities. If you follow a product's life cycle, we're investing in product design software. First of all, we're investing in sustainable and smart materials and natural ingredients to make the product. We're investing in sharing economy business models during a product's life, and then ultimately recycling to feed it back into the front end of the loop. So you can see the range of opportunities in that. And then maybe finally, sustainable food and agriculture. Food and agriculture is one of the most resource-intensive industries out there, or set of industries. But we're investing in the companies that are improving efficiency and reducing the environmental impact. And that can be anything from sustainably managed forests and salmon farming. It can be natural ingredients. It can be software for the connected farm. So again, a huge range of opportunities we're investing in.
Those sound like very exciting areas. Can you give some stock examples of companies you're very excited about in those three themes?
Yes, if we take energy efficiency and energy storage, a name that's in the portfolio is Generac. They're the dominant market leader in backup power in North America, so solution provider during hurricane seasons, wildfires, etc. But their real strength is in their brand and their distribution. We'd been talking to them about the emerging opportunity around energy storage. So they made a bunch of acquisitions, and they're now one of the leading suppliers of energy storage products that are going into homes alongside solar. That's a market that's only beginning to open up. In terms of circular economy, I would draw out a company called Herc. So we talked about the sharing economy. And so an area that we're interested in is equipment rental. We don't need to own these capital goods, right? Rental makes a lot more sense, and there's a huge lifetime emissions saving. So it's a consolidated market in North America. There's still a lot of growth from penetration, and we liked Herc because it's less well known. It's catching up on profitability and returns compared to Ashtead and United Rentals, and it traded at a big discount to the other players. So that would be an example on that front.
The fund invests in small and mid-sized companies.
Yeah.
Is that a riskier area of the market? And if investments that you own become large, they become very successful, is there a discipline on selling holdings once they become too big?
So it's true, this is a small and mid-cap opportunity. Small and mid-cap companies can outperform or underperform depending on prevailing market conditions, right? So they're probably slightly higher risk compared to broader, overall kind of broader equities. We're investing in that area. It's partly just the evolution of environmental markets. When we first started 20 years ago, these were small niche markets that were served by small kind of micro cap and small cap companies. But if you roll forward to today, these are large, well-established markets served by large, well-established mid and small cap companies. But we still prefer that area for investment because that's where you get the growth, and that's where you also find companies that are maybe less well covered or less well understood by the market. So that's why we focus in that part of the market.
Industrials is a big overweight. This is a sector which actually is under a bit of pressure at the moment due to higher supply chain costs with all this inflation. Does that worry you? And is this inflation feeding through into profit margins?
Yeah, you're right that inflation and supply chains probably been one of the biggest challenges, particularly for industrial companies over the last year. So it's been felt particularly in certain industries like automotive, where they're reliant on supply of chips, and also in smart metering companies that also have that same reliance. So companies are definitely wrestling with component availability, material cost increases, but also overheads like salaries, logistics, you name it. So in this environment, the key is to have pricing power, right? So one of the most important parts of our research process is to only invest in companies that have strong market position and strong pricing power. So I think overall, we're really pleased with the way our companies have managed these challenges, and that was evident in a pretty successful Q1 earnings season.
Another big area that you like is utilities. Some people think this is a dull investment area. Why do you want to own boring utility companies? So why do you own them, and why are they exciting?
Well, I'd say not all utilities are boring. And it's true, we're only investing in utilities where we feel there's something special, where we feel there's a strong growth story. So the biggest part of our utility exposure is in renewable power utilities. So these are project development companies that are delivering a pipeline of projects, right? So they're getting them through planning, they're taking construction risk, and they're getting these wind farms, solar parks, bringing them into reality. So we see a lot of value creation in that process. You know, a lot of the companies we're investing in, they're looking to double their capacity in the next 3 to 5 years along this track to net zero. So they can be really strong growth in those areas. Otherwise, we do invest in a few water utilities, but it's only where there's something interesting. No? So we invest in the US, which is a fragmented market that's consolidating. We invest in the São Paulo, Brazil water utility that's providing solutions into a drought-stricken area. So I would argue they're all really compelling investment ideas. But what they also do is bring some stability and some balance to a portfolio that helps balance some of the more volatile, more cyclical sectors.
Jon, thank you very much for coming into the studio.
Thanks for having me.
And that is all we have time for today. You can check out more insider interviews on our YouTube channel. Don't forget to like, comment, and subscribe.